The prior example is an interest-bearing note. It has explicit interest rate on the note. There's another one, we called it non-interest-bearing notes. Non-interest-bearing note now means there's no interest for this note. Okay, it just doesn't specify the interest rate. It does not mean there's no interest. Actually, the interest is a discount from the face value of the note. And the discount on note receivable represents future interest revenue that will be recognized over time. There is also a control account to the notes receivable. So let's take a look at this example. This is also same example as the prior one, but it doesn't specify the interest rate on this note. The sales happens on May 1st, 2025, and also 6 months notes, so the notes will be due on November 1st, 2024. So these two transactions all occur in 1 year. First, because the agreement is $700,000 notes receivable in 6 months, so we're going to debit receivables. This is amount to be received after 6 months from the sales. That's the future value, right? And we need to calculate the present value of this. Since we are given this is a cash price, $658,000. That represents present value of these notes on May 1st. So here you should know this $700,000 is notes receivable in 6 months. That's the value after 6 months. Well, its value at current on May 1st was $658,000. The difference actually is a discount. Okay, so we will debit notes receivable $700,000, credit discount on notes receivable, and the revenue actually is a cash value of these receivables. And when the notes due on November 1st, the customer will make the payments for $700,000. So we will credit notes receivable, write off these notes, collect cash payments. At the same time, we will actually kind of amortize the discount on notes payable. Originally, it has credit balance. Now we debit discount on notes payable and also recognize the interest revenue, $42,000. That's what it said. The interest actually is a discount from the face amount. So here the discount was 42. The interest revenue earned over time was $42,000. This transaction can be explained this way. Originally, the price of the goods was $658,000, but the company, the seller, chose to receive a bigger amount 6 months later for $700,000. Although the company deferred the cash receipts from the customer for 6 months, but it can earn extra interest revenue. Although this non-interest bearing note does not specify the interest rate, but actually we can calculate its interest rate or effective interest rate. The interest $42,000 is on the principal, so 6.383%. That's the rate. Remember, that's the rate for 6 months. To convert to annual rate, we just multiply by 2. So that's the effective interest rate, 12.766%. Similarly, if the sales not happened in May 1st, it happens on August 1st. That means the note will be due next year on February 1st. We are making this journal entry by debit notes receivable $700, credit discount on notes receivable $42,000, sales revenue $658,000 on August 1st. So here in this slide, we do not repeat the journal entry made on August 1st. On December 31st, that's the end of fiscal year, the company should prepare its financial statements, so we should accrue the interest revenue based on the given information. Because from August 1st to December 31st, that's been 5 months, so we should accrue 5 months interest revenue. So we are going to calculate $35,000 interest revenue. What we do is we debit discount on notes receivable 35, credit interest revenue $35,000. That will guarantee this amount of interest will be recognized as revenue in 2024. In 2025, there's only 1 month for the life of this note. So the company will debit discount on notes receivable, 1 month interest, and 1 month interest revenue recognized. When the note is due, the company will receive $700 and write off notes receivable by credit notes receivable. So the difference of this scenario with this one is this. Look, if we ignore the dates, these two accounts, if we combine, the sum of them are $42,000. If we combine these two, the sum of both are $42,000. Okay, so the amount is no different from the example here. This scenario, the end of fiscal year is in the middle of notes. So we need to split the $42,000 into 2 fiscal year. 35 in 2024, 7,000 in 2025. The reason is there are 5 months in 2024. There is only 1 month in 2025.